I'm Stuart Jackson, Portfolio Manager at Montgomery Investment Management. Welcome to this week's Video Insight. One of the high-quality businesses we have held for a long period is the online job board and talent search company Seek. Seek recently reported its results for the 12 months to June 2018. This provided incremental detail on the company's performance following on from the release of its trading update at the start of the prior week. It's fair to say that the market's interpretation of the trading update differed from our own. The market focused almost entirely on the earnings guidance provided by the company for the 2019 financial year. Group net profit is expected to be roughly in line with the earnings generated in 2018, while earnings before interest, tax and depreciation is forecast to grow between 5 and 8%. This was 14% and 6% below broker analyst forecasts respectively. The announcement saw the stock fall 9% on the day. Our focus was more on the company's expectations for revenue growth in the 2019 financial year. In the 2018 year, Seek reported 24.4% revenue growth. This was a strong result driven by an acceleration in revenue growth in the Australasian, Chinese and Asian businesses. Management expects the company to generate between 16 and 20% revenue growth in 2019. While on the surface this appears to be a slowing in the rate of growth, the 24.4% growth rate realised in 2018 overstates the true underlying rate of growth due to the change to consolidate the company's investments in OES and Sidekicker. Excluding this change in accounting treatment, underlying revenue growth in 2018 was around 14%. Additionally, in the second half, underlying revenue growth was just over 16%, as compared to 11% in the first 6 months of 2018. This demonstrates that underlying revenue growth accelerated through the year. Management's guidance for 2019 implies a further acceleration in revenue growth beyond the rate of growth recorded in the second half of 2018, despite slowing job ad volume growth in Australasia. The acceleration in revenue growth is being driven by the company's investment in value-added premium products combined with its strengthening position in key Asian markets as it pursues a scale and network effect advantage. The market's focus on near-term earnings outcomes misses the fact that Seek is strengthening its position in markets that have the potential to represent a longer-term profit pool, which is many multiples of that generated in its Australasian businesses. While most companies undertake the bulk of their investment through capitalised spend in existing businesses or through acquisitions, the majority of Seek's investment is expensed through the income line. As such, its reported earnings are a blend of a very high margin existing business and losses due to expensed investment in future products that are expected to deliver long-term revenue and earnings growth. Assessing the value of the company based on a multiple of these combined amounts produces a misleading outcome in the same way as it would be in looking at the valuation of a more traditional growth company based on its multiple of its cash flow, including total capital expenditure. While Seek's long-term success in these Asian markets is still far from being assured, its improving market position, product suite and willingness to invest to improve its competitive positioning is continuing to deliver positive outcomes. That's all for this week. We'll be back next week. In the meantime, you can follow us on Facebook and Twitter.